Well, I must say I really enjoyed that previous presentation, but the prediction that we're going to have markets open 24/7 is disturbing. I would like to get some sleep. So I don't really mind the hours that the markets are open now, but these days there are markets that are open 24/7, or basically that much. If you've been trading GLD, it doesn't trade other than during the hours of the New York Stock Exchange. But on the other hand, you can get a quote for gold. If gold's going the wrong way, there's not much you can do with GLD, but maybe there's other ways you can just either bail out or buy some more. Anyways, let's get right down to it. I'm not in the recession camp. I haven't been in the recession camp. I have been in the recession camp for quite some time. As a matter of fact, over the past 3 years, there were quite a few people who thought we were going to go into the recession. And I think over the past 3 years, we've had the most widely anticipated recession of all times. That never happened. It was the Godot recession. It just refused to show up. I think a lot of people were kind of looking at the economy on a historical basis. They were looking at charts. And charts showed that when the Federal Reserve tightened monetary policy as much as they had over the past 3 years, that the result was always a recession. And so tightening of monetary policy leads to recession was kind of the widespread view. And then, of course, we had the falling yield, the falling index of leading economic indicators, another indicator suggesting we were going to go into recession. It's been doing that since, I think, 21. So it's been a misleading indicator. The yield curve inverted there for a while, and people said that every time the yield curve is inverted, we've had a recession, and we said no, we didn't think so. I think what people didn't really understand is that the tightening of monetary policy and the impact on the economy works as a process. Just because the yield curve has always inverted before the recession occurs, doesn't necessarily mean that you understand the process. You really have to understand the process to understand whether it's likely to happen again. And as we've all had experiences in the markets, just because something happened over and over again doesn't mean that, it actually means the probabilities are probably running against it. And contrary thinking, more often than not, can create a lot of opportunities. But I think what people missed is that what really causes recessions, or most of the recessions, has been the tightening of monetary policy has led to a financial crisis, which is plausible. Not everybody anticipated that rates would go up. People borrowed at low interest rates. They might have to refinance. And so to the extent the banking system was very important in the past, banks would suddenly find that maybe some of their loans were blowing up. And when that happened, the banks would have to pull back. And so the financial crisis would lead to a credit crunch. And it's the credit crunch that caused recessions. Now, interestingly, over the past couple of years, we did have something that looked like it was going to work that way too, because we did, in fact, see that the tightening of monetary policy led to a banking crisis in California. But the Federal Reserve came up with a liquidity facility very, very quickly. Ever since the great financial markets, it's learned how to respond to these liquidity crises by providing liquidity. And so it knows very well how over a weekend, overnight, to create emergency liquidity facilities. And just by doing that, that calms the markets down, so the crisis doesn't become a credit crunch, and therefore that doesn't become a recession. Some other recessions were also associated with rapidly rising oil prices. What we know about commodity prices generally, and oil prices specifically, is that the best cure for high commodity prices, for high oil prices, is high oil prices, because that brings that depresses the demand and it increases the supply. And so that doesn't seem to be really much of a factor anymore. So we didn't have a recession. And I also had a belief that the underlying economy was much more resilient than it was in the past. Let's talk about some of the sectors that have turned out to be better than was much feared. Let's talk about the consumer. I'm a baby boomer. A lot of my friends are baby boomers. A lot of them have already retired. Some of them are going to be retiring. The baby boomers have a tremendous amount of wealth. Let me just see if I can get this thing to work. This is just, by the way, our view of what's going to happen to real GDP. We think it's going to grow 1.5% to 2.5%. I will say that I changed that from 0.5 to 1.5% on Monday. Like everybody else, we were all surprised by the extent to which there was an agreement to negotiate on trade between China and the United States, and that pretty significantly reduced the chances of a trade war and a trade-related recession. So we're back to thinking the economy is going to be growing solidly. Not everybody agrees. Some people think there's still kind of a lagging shock effect from what's happened so far. But again, we're betting on the resilience of the economy. We're also thinking that inflation, as measured using the personal consumption expenditures deflator, we actually back in 2022 said that we thought that was the peak during the summer and that inflation will come down. Inflation tends to be fairly symmetrical. It goes up fast and then it comes down fast, and it does that in a very symmetrical fashion. We also did think, as a lot of people agreed, that it was supply chain disruptions that were creating the problems and that those would get fixed. And so we did predict we'd get down to 3 to 4% by 2023, and then by 2024 we thought we'd get down to 2 to 3%. Now we think there could be a short period of time, kind of a stagflationary episode, not the long-term phenomenon where inflation picks up to 3 to 4%. But it's not inevitable. Oil prices are still weak. The Trump administration says they're making some progress in negotiating with Iran. If that's the case and that happens soon, there could be a lot of Iranian oil flowing into the marketplace, which could mean lower energy prices, which would, of course, help to keep inflation down and offset some of the price pressures from the trade war, which didn't last very long. Then we think inflation settles back down to 2 to 3% because we believe that the economy's productivity, which has started to recover in 2015, the growth rate back then was 0.5% on a 5-year trailing basis. The growth rate of productivity, at least until the latest quarter, was closer to 2%. Latest quarter, with real GDP being down, I think we had an aberrational weakness in productivity that'll be reversed rather quickly. So here's the point I was making before with regards to the consumer. This is the household net worth of generations. And as you can see, the total is like $160 trillion. Look at the baby boomers. The baby boomers have over half of that. They've got they've got $82 trillion in net worth, not billions, but trillions. Some of you are my fellow baby boomers, and many of us grew up watching Star Trek. And on Star Trek, Star Trek Spock, remember our parents raised us based on Dr. Spock, and we listened to Spock, the Vulcan, in Star Trek, where he said, "Live long and prosper." And we're doing that. We're doing that as best we can. We're living long. And if you invest along the way in houses and stocks and bonds and insurance policies and gold, just have accumulate assets. We have seen them rising in value over time. And so you can see that there was a time when the baby boomers were younger, where they didn't have much in the way of net worth, but now they've got $80 trillion. Now, as I mentioned before, I think the baby boomers are going to do everything they can to spend the money because their kids were annoying, and so why leave anything to them? But I don't think they can spend $82 trillion no matter what they do, and so I think there will be a lot of inheritances passed on to the younger generations. In addition, I think there's a lot of intergenerational transfers of wealth. Again, I know this from my personal experience. Whoa. Is that something I did? Okay. Anyways, so there's a lot of intergenerational transfer of wealth going on. And I think that's, these days, kids coming out of school with a BA, a college degree, many of them seem to be studying exactly the same subjects. They're graduating with business and communications degrees. I don't really know what that means exactly. You can talk, you can write. You would think so, but I've seen some of the communication skills of the younger kids, and they could use a little help in that regard. But maybe they're making $40,000, $50,000, $60,000 coming out of school with a BA. Auto insurance costs $5,000 a year for one kid, for one person. They can no longer afford to rent a one-bedroom or studio apartment. They have to share these things. So I think the kids who are, in fact, in a one-bedroom studio apartment, and again, I know this from my personal experiences, they got dad helping them, dad and mom helping them for these expenses. And I think there's also generational support in the housing market and education market. Grandparents are helping to pay for their grandchildren's educations or sports activities and the like. So we've never had a richer household sector than we have today, $160 trillion. We've never had a generation this wealthy as is the baby boom generation with $80 trillion. And as they retire, I would expect that the savings rate, the country saving rate, will actually go negative. Because if you retire, you're not getting an income anymore. Maybe there's some interest and dividend income, but there's no longer wages and salaries. And so if you retire and you're spending, you obviously have a negative savings rate. Now, I'm not retired, but my friends who did retire, going on cruises seems to be very popular with them. I get seasick, so I don't go on cruises, but they love cruises, and they used to maybe go to cruises when they were younger, maybe with their families, maybe once every 5 years. Then suddenly they're retiring and they go on a cruise and they like it a lot, and suddenly they're taking 2 cruises a year. And I'm getting text messages from my friends like 6-9 months ago saying, hey, we're having a great time, wish you were here. Meanwhile, what's going on with this market? It just keeps going up. It's great. We're spending all this money on cruises, we're buying things when we get to the various locations, and our net worth keeps going up. I mean, life is wonderful. Then, of course, over the past few months, it kind of all reversed, and the text messages I'm getting is, Ed, what the hell's going on with this market? It's killing me, and I'm canceling the next cruise. I just don't know what. So there is a wealth effect on consumers, maybe greater than ever before, and so clearly this rebound in the stock market is very helpful in eliminating what looked to be a very significant negative wealth effect, and now potentially creating it still a positive wealth effect, because people clearly have a lot more net worth than they had a year ago, and they're feeling a lot better about their portfolios now that we've had this big rebound. Now, some of that sell-off that we had in the market this year, we actually anticipated a correction in December. In the beginning of this year, we thought there could be a little bit of stress, uncertainty about how these policies were all going to add up. We weren't pounding the table on it because when we call for a correction, we're not really telling you to get out of the market. We're just telling you that it could go down. Don't panic, and if you got some cash, it might be a buying opportunity. And it turned out to be a correction. The S&P 500 was down 18%. The NASDAQ was down, I think, 25%, so it was more of a bear market, but it was like a nanosecond. In other words, if you're going to get cute and try to pick tops and bottoms, you got to pick tops and bottoms. Over the years, my track record is pretty good at calling bottoms. I'm still working on tops, but then at bottoms I say, this is it. This is a good buying opportunity. Now, the reason I'm so good at calling bottoms is because I have a relative who I rarely speak to. We don't really like each other, and we both know that. But every time the market bottoms, he calls me up right before it bottoms. He says, Eddie, I know, he's real friendly. Eddie, I know we don't talk very often, but what should I do here? I'm thinking of getting out of everything in the market. So whenever I get that call, I know that's the bottom. And wouldn't you know it, in early April, I got that call again. Now on April 7th, which was a Monday, we wrote a piece called Annihilation Days. There was Liberation Day on April 2nd. And April 2nd, the Liberation Day was announced at 4 p.m. at the Rose Garden, so the market was already closed. But the next day, the market gave us its Bronx cheer for this Liberation Day program, and we saw 2 days of annihilation in the marketplace for sure. And so I wrote this piece for Monday, April 7th, and usually we release it an advanced copy the evening before. And what I wrote is that there's no way Trump is going to ignore this message from the stock market, and he's going to have to at least postpone the tariffs while he's talking with countries, our trading partners, about what he wants. And then we also wrote that if and when he does that, we get a V-shaped recovery in the stock market. I didn't know that 2 days later, that's exactly what happened. We had a V-shaped recovery in the stock market. I was on CNBC with Scott Wapner, and Scott tends to be a little bit more pessimistic and bearish than I am, but we were both very impressed with the almost 10% increase in the S&P 500, and it was very, very powerful, and it's continued to rocket ship to the upside. By the way, some of these contrarian indicators have worked very well for us. We do look at the Investors Intelligence Bull-Bear ratio. We do look at the AAII Bull-Bear ratio, and I did write in January of this year that there were too many bulls around, and that from a contrarian perspective, that was probably bearish. Then again, right around the bottom in the market, we pointed out that The Economist had just written 4 cover stories, one right after the other, 4 consecutive cover stories, basically about how America wasn't exceptional, that Trump was destroying the country, everything was going badly. And The Economist has a great record of being a contrary indicator. As a matter of fact, October of last year, The Economist had a cover story that focused on the exceptionalism of America. They had a cover picture of a wad of dollars that were shooting up like a rocket ship and how strong the dollar was. And then all of a sudden, when right in April, they're saying how terrible things all of a sudden look, and how Trump is destroying the global order, and that the dollar is going to no longer be a key currency, and yada, 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 as Seinfeld would say. But you put it all together, and we said, this is like this. I wrote a piece that this may be the greatest buy indicator of all times. And the Investors Intelligence survey data bull-bear ratio as well as the AAII bull-bear ratio were very, very depressed as they were in the previous bear markets, previous recessions. And we just didn't think things were all that bad. And again, when Trump blinked and postponed the tariffs on April 9th, we then believed that April 8th might have made the bottom in the correction. And I still think that, as I mentioned before, I don't know what it is about these billionaires where they tend to be so depressing and depressed. I mentioned Ray Dalio. I mean, Steve Cohen is in the news the past couple of days saying he thinks we're going to retest the market lows of April. Again, I don't quite understand. They should be happy. I mean, they're rich. Why not have an optimistic view that clearly somehow they got rich in a country that gave them the opportunities to do that? Why don't let the rest of us try to get rich instead of telling us that the world's going to come to an end? But I use them as contrary indicators when the billionaires, including Druckenmiller and some of these other people, come out with their public remarks. I suspect their trading portfolios don't necessarily reflect what they're telling the public. And again, I don't know. Why not just be quiet? Don't share your pessimism with us. So let's talk about the consumer. We just talked about the consumer, I should say. And look, this is not to say that there aren't consumers that are distressed, that are delinquent on their loans. There certainly are. This is not to say that you can't do a survey and find that a lot of people will tell you that they run out of money. Their paycheck doesn't really cover them through the end of the month. And the surveys never said, well, so how do you make it through the rest of the month? And the answer is, my dad pays my credit card bill. Again, I know this from personal experience. So how about technology? Well, the fear was that all this uncertainty about trade would lead to a collapse in capital spending. Well, more than half of capital spending is technology, and I would argue that willy-nilly companies have to spend on technology to increase their productivity, to increase their efficiency, to stay competitive. And if you don't do that, if you don't invest in technology to do that, and your competitors are doing that, then you're going to fall behind. You're going to go out of business. And so I think there's a resilience to technology capital spending. But we also have, when Biden passed his IRA legislation, we still have a lot of onshoring that's going on as a result of Biden's programs to bring back semiconductor production and into the country. And then Trump, while he was scaring the living daylights out of investors, he was at the same time saying, throwing out numbers like hundreds of billions and even a couple of trillions here and there of money that foreigners had committed to spend in the United States. And if nothing else, is the Trump tariff turmoil clearly convinced a lot of companies that they have to have more of their production in the United States. So where does that put us in thinking about the market? So the economy, I think, is resilient. I think it's going to grow. I don't think we're going to have a recession. We could have something that kind of adds up to stagflation, a little bit more inflation, maybe some slower growth during the summer. But I think overall, the stock market has started to increasingly look past all this into the 2026 and seeing a pretty good environment. And we've been arguing since 2019 that the 2020s could turn out to be the roaring 2020s. Obviously, the analogy being with the 1920s, it rhymes with that. 1920 started out awful. A couple of years before that was the end of World War I. At that time, they called it the Great War. There was only one World War. That was it. And then in 1919, they had the Spanish flu, which was much worse than what we had with COVID. Tens of millions of people died because of that. And then in 1920, we had what they called a depression in the United States. So if you were starting out at the beginning of that decade, you had to be pretty pessimistic about the outlook. You never would have imagined that it could turn out to be the roaring 1920s, which is what it turned out to be. So again, there's similarities with the way our 2020s have started in the 1920s. But the other similarities, of course, are technological innovations that increased productivity. Am I okay on time?
I want to make sure I'm ready for questions.
Okay. I'm just going to speak for another 3 hours. Okay. I'll keep it short. So there's a lot of technological innovations. Let me just put AI in perspective for you. I think AI is just an evolution in the digital revolution. The digital revolution started in the mid-1960s with the IBM mainframe. The idea of the digital revolution is to process as much data as we possibly can, as fast as we can, as cheaply as we can. And we've made a tremendous amount of progress in that regard. I view information, data, as kind of the fourth factor of production for our economy. There's land, labor, and capital. Well, there's also data now. And so from the IBM mainframes to the digital equipment, mini computers, to the PCs, to the cloud, we now have AI. And AI is really just another way to dramatically increase the pace at which we can process, analyze data, and come up with some conclusions. And it can do it relatively cheaply with these LLM models. I think some of it is hype. I don't think it's as revolutionary as some people think. But I think it does create, it is kind of, I kind of view NVIDIA chips as basically supercomputers, kind of the next evolution of supercomputers. And again, that allows us to process more data more quickly. And of course, the more we can do that, the more data that we come up with to process. And so everything becomes data, and everything puts a demand on the AI infrastructure, which is really the cloud infrastructure. That's really what it's all about. Trump was just over in Saudi Arabia and sold the Saudis 18,000 chips. I don't think they know what to do with these things, but they now have these chips, and they want to build data centers. I guess they figured they got the energy to power them. I do think that there's similarities with the 1920s. I was concerned for a while about the 1970s. Less concerned about that now. Sort of a stagflationary environment. I don't think we're going to get that. I was concerned about the repeat of the 1990s, a melt-up. I'm thinking maybe I have to go back and be reconcerned about that. Having melt-ups, leads to meltdowns is not a great environment for investors. Bottom line on these markets is I think the treasuries are where they should be. They're back to where they were before the great financial crisis. So 4.5% makes sense to me. And I think the market, I started out the year very optimistic, using 7,000 for the S&P 500. Then I got knocked off path by all the turmoil that was going on with Trump's policies. I did warn my clients that I reserve the right to change my forecast as often as Trump changes his mind. I didn't change it as often as he did, but at any rate, we did figure out that April 8th was probably the low. It took us a few days to figure that out. And now we think that the market's going to go up to 6,500 by the end of the year. And I can't dismiss the possibility of 7,000 if this thing really just goes into a melt-up phase. Then next year, 7 to 8,000. Then I think we get to 10,000 by the end of the decade, which is just kind of extrapolating fairly normal growth rate in earnings. What's different this time would be that the valuation multiple stays this elevated for this long. Sure.
Okay, we definitely. I would like to fit one or two questions in, and then just as a reminder, Ed will be out there in the sponsor area answering questions, meet and greet occasion during lunch. So you'll have a chance to ask him a question then if you don't get to now.
Hi, Ed Colvin in Atlanta. A couple of questions. One, were you surprised by the PPI decline? And secondly, do you feel like the Fed and their mandate that they're kind of chasing the boogeyman here with the inflation?
I follow something called there's a nowflation that the Cleveland Fed posts, and they update it every day, and I guess they're monitoring plenty of prices, and they were predicting that the CPI would be 0.2, and that the core would be 0.3. So I was the 0.3 was actually a little bit higher than it was anticipated. But I'm actually more surprised that gasoline prices haven't dropped more with the way that the price of oil has dropped. Not surprised to see that used auto prices are going up. Still think that the 25% tariff on the auto industry is, I don't get it, but it is what it is. And that's driving up, that'll drive up car prices here pretty shortly. But look, I think everybody knows this. I think everybody knows that we're going to get hotter inflation numbers, because everybody knows it. Again, my contrary instincts come out and say, well, maybe it won't happen after all, especially if we have a big flood of Iranian oil coming into the global oil markets. But it doesn't really matter. I think the stock market's kind of looking through it. I don't think the bond yield is at 4.5% is anything to worry about. Some people look at it like it's some sort of calamity, like it should be lower, but it's perfectly fine where it is. And I don't think the bond market is worrying about a short-term hotter inflation. I think it's actually probably monitoring what's going on in Washington with the tax bill, and of course that's not a tax cut. It's an extension of the tax cutting bill. And if the bond market doesn't like it, we'll go up to 4.75%. If it really doesn't like it, we'll go up to 5%. And as we've just seen, this administration overnight became very sensitive to the bond vigilantes. April 8th is when the bond yield jumped from 4% to 4.5%. And Trump said the reason that he postponed the tariffs is because of the volatility in the bond market. The other question was the Fed. The Fed's mandate stays the same. We've got the unemployment rate at 4.2%. We got the inflation rate, let's say 2.5%. It's like, tell me again why we need to do anything. So I've been in the camp saying none and done. I was actually opposed to the Fed cutting rates by 100 basis points last year, but hey, they just won't listen to me. And I warned early on that the bond yield would actually go up instead of down, and everybody was scratching their head. It's like, why is the bond yield going up? And then we said, well, because the bond market agrees with me that it wasn't really necessary for the Fed to cut interest rates.